This activity analyzes the effect of some macroeconomic variables on the supply and demand for currency in the foreign exchange market, on the equilibrium exchange rate, and how to diagram those effects. Consider how an increase in income in Ecoland will affect the supply and demand for currency in Ecoland on the foreign exchange market and the foreign currency price of the EcoBuck. First, if the number of EcoBucks is measured on the horizontal axis, then on the vertical axis, we would have the price of EcoBucks, its exchange rate. The price of EcoBucks would be the number of Macrobucks if we're talking about the Macrobuck EcoBuck market per EcoBuck. The supply curve, upward sloping, the demand curve, downward sloping, will produce an equilibrium exchange rate at the intersection, and let's suppose it's 0.5 Macrobucks per EcoBuck. If now real income increases in Econoland, then the residents of Econoland will want to increase their purchases of goods and services. Some of those purchases will come from other countries. One of them will be Macroville. If residents of Econoland are purchasing more products from Macroville, then they will want to buy Macrobucks in order to make purchases in Macroville. In order to do that, they will supply more of their own currency to buy Macroville's currency. So the supply of EcoBucks will increase on the market. The result of that will be a change in the exchange rate from 0.5 to something less than 0.5. So there has been a depreciation of the EcoBuck as a result of the increase in real income in Econoland. The effect of the increase in imports by residents of Econoland was analyzed in terms of the market for EcoBucks. We could have analyzed the effect for Macrobucks. If we had analyzed the effect on Macrobucks, then we'd have the quantity of Macrobucks on the horizontal axis, and the price on the vertical axis would be the number of EcoBucks per Macrobuck. Given a supply and a demand, and an initial exchange rate in the EcoBuck market of 0.5, that would be 2 EcoBucks per Macrobuck. With the increased supply of EcoBucks, there's going to be an increased demand for Macrobucks. So the demand curve for Macrobucks moves to the right. That causes an appreciation of the Macrobuck to something greater than 2 EcoBucks per Macrobuck. Now we use the supply and demand for currency to analyze the effect on the foreign exchange market for the dollar. With the quantity of dollars on the horizontal axis, on the vertical axis, we'll have the price of dollars. In terms of the yen, that will be the number of yen per US dollar. Given some supply and demand curve, we'll have an equilibrium exchange rate. I'll just call that E1. With an increase in the real interest rate in the United States, residents of the United States will want to reduce their purchases of Japanese assets, and so there will be a reduced supply of dollars on the foreign exchange market. Residents of Japan will want to buy more US dollars because returns in the US are higher, and so there'll be an increase in the demand for the US dollar. The result of the shift of the supply curve to the left and the demand curve to the right will mean an appreciation of the dollar from E1 to E2. So an increase in the real interest rate in the United States will cause an appreciation of the US dollar. Finally, we'll analyze the effect of an expected appreciation of the euro relative to the US dollar. An appreciation of the euro relative to the US dollar, if it's expected, it means that in the future, investors think that the euro is going to be worth more dollars. If the euro is going to be worth more dollars, then the dollar is going to be worth less euros. If we put the quantity of euros on the horizontal axis, then the price of euros, which will be dollars per euro, will be on the vertical axis. If the euro is expected to appreciate, then investors want to get into the euro. So given some supply and demand and the initial equilibrium exchange rate, there will be an increased demand for euros, and there will be a decreased supply of euros, resulting in an appreciation of the euro. So an expected appreciation of the euro will cause a current appreciation of the euro.